Well, hello everyone. Thank you for joining us. My name is Bob Ingram. I'm a financial planner here at Center for Financial Planning. And when thinking about education planning, for most families, paying for college isn't just another expense. It can be one of the biggest financial decisions you'll make. In fact, for many parents and grandparents, it sits right alongside retirement as one of the most important goals. And how to go about saving for college can certainly feel overwhelming. What's the best way to do it? How could it affect other things you might be planning for? Or, what if our plans change? All key questions. And as a comprehensive planning and wealth management firm with over 40 years of history, we've helped hundreds of families navigate these critical questions, helping them successfully send their children and grandchildren, and even in some cases, great grandchildren, to college. And while there's no shortage of ways to save for education, college savings plans really have quietly evolved into a more flexible, tax efficient tool, really with more use cases than ever before. So today we're excited to have John Scott join us from TIAA and Michigan Education Savings Program. And before we're introducing John, just as a quick note, just we can make the most of our time today. We won't be taking questions, but if something does come up, we'd love to hear from you afterwards. So please don't hesitate to reach out to your planner or to either one of us. Happy to answer your questions. Really look forward to it. And with that, it's my pleasure to introduce John Scott. John is a dedicated education savings consultant at TIAA-CREF Tuition Financing. With a strong background in financial education and planning, he earned his bachelor's degree in political science from Central Michigan University and holds the FINRA Series 7, 63, and 65 registrations. He focuses on educating families to understand strategies to save for their loved ones' college educations. So, John, as we kind of start, kind of setting the table a little bit, certainly as I mentioned, the whole decision-making process of college savings and college planning, there's still such a multitude of options out there of how you can save. Just as an example, the different kinds of investment account options are out there. So regular investment accounts, opening up a basic brokerage account, investing, saving over time, building those investments. And of course, that can be a flexible way because it's not specific to education. But there's no real tax benefits. You pay taxes on dividends or on interest earnings, capital gains taxes. So you don't find as much of an advantage with those necessarily. Then there's custodial accounts, actually gifting accounts to minor children. Okay, it can be a way to save. It has some flexibility because it's not education only. It does have to be for the children's needs. And the other thing is, of course, it's an irrevocable gift. So the idea is it becomes the actual beneficiary's asset. So for parents that are saving for kids, let's say, or grandparents saving for grandchildren, they kind of lose that control of the dollars, how it's used once the children reach the age of majority. And of course, it varies by state, but 18 here in the state of Michigan, it's their money legally. So sometimes not the best alternative to keep that control. Other things like retirement accounts. A lot of questions oftentimes for many clients are, well, I've built some retirement assets, IRA, Roth IRA, can I tap those assets for college? And the answer is kind of a yes, but keep in mind that there are penalty-free withdrawals for college, but from a Roth, you have to pay taxes on the earnings, even if they're used for education. And yes, it's an asset for the parents. Let's say if it's a parent asset, so there's some financial aid considerations versus children's assets. And we'll talk a little bit more about financial aid. But realistically, those kinds of accounts are truly made and designed for retirement. So it's sort of the opportunity cost. If you use them for education, there are less dollars there growing for, again, those other very important goals like retirement. And there's only so many ways to grow, assets tax-free, and a Roth is one of them. And then there's things like Coverdell education savings accounts, the old education IRA. It is specific for education. It can be used, and tax deferred growth and earnings can be used, certainly tax and penalty free, if used for qualifying education expenses, college, and also K through 12. One of the downsides is historically has had pretty low contribution rates. There's only so much you can contribute in a year. So there's limited upside of what you can actually build over time. So, there are pros and cons with many different options like this, but maybe not to the same degree of power that many college savings plans and 529 plans might have for many families. So when we're thinking about that, some of the questions we'll want to ask and uncover today, really, simple. What is a 529 plan? Lots of ins and outs with that, a lot of misconceptions. Why would we want to use a 529 plan? What's the objective? What's the goal for that? Who can contribute? Who may not be able to contribute? When can you use it? Under what circumstances? And I've said there's some interesting, expansive ways that 529 plans, college plans can be used. What does it not cover? There could be some pitfalls and some simple little landmines to avoid when using these. And again, just any kind of misconceptions or things that people assume that might not exactly be right. So we're going to really try to cover these and get a good, better understanding of kind of the landscape of where college savings plans are here in 2026. So with that, let's kind of talk a little bit more specifically about 529 plans. What are they, and go from there.
Well, thank you, Bob, and that was a wonderful introduction. It's hard out there playing for college. I mean, they don't teach us in school about playing for college. That would be helpful for a class about that. But the good news is with MESP, we do have a lot of resources to help. And obviously, in this presentation, we're really going to break down a lot of the important information that you need to know when you're starting to make that decision about saving for a loved one's higher education. So to go back here, going a little bit too far forward. Let's see if I here. Here we go. So my name is John Scott. My job is to help people across the state of Michigan save for higher education. So I work across basically the entire state, everywhere from my area, which is Lansing, all the way up to the UP. So I travel year round, mostly working with people who are saving for school, but I also work with employers a lot to educate their employees. So a lot of my work is just working throughout the community in different ways to spread awareness about this program and about the rules. And when we talk about paying for college, we're obviously going to look a lot at the cost of paying for school. So when we think about public in-state school, that cost is going to be around that $30,000 mark. For Michigan State, you're looking around 31, 32. For the University of Michigan, closer to 34. Your Centrals, Westerns, Michigan universities, Eastern, you're going to be looking closer to that 28 mark. So around that 30 mark is what you're going to be looking at for those schools. So that's an important cost to keep in mind, and that's an all-in cost each year. Now, if they do end up going to community college first, that is covered tuition free in some areas in the state of Michigan if you have one in your area. But you want to look that up. But even if that does mean tuition free, that doesn't mean totally free. Of course, that's a great way to save money to then transfer to a 4-year college to save a lot of money in that conversation. But out of state school, we see rising significantly. So this number that you see at about $58,000 was in the 40s when I started this job 2.5 years ago. So that average has moved up significantly. And then you look at public or private schools in the state of Michigan, that's rising. At the highest end, you're looking at Kalamazoo College, which is around $70,000. And if we even move out of the realm of Michigan to other private schools, for the very high achievers out there or people that want to go to your small liberal arts schools, your Ivy Leagues, you're seeing closer to $80,000 to $90,000 full cost. And it's important to note that these numbers are right now. So these these aren't expected to go down anytime soon, which is unfortunate. But the good news is that we have we're going to have a conversation about how to save for that. And the real reason why having this conversation is very important is you'll see in the past slide that it takes about 20 years to pay off student loan debt. That's an average. But when we think about philosophies on saving for school, one of the ways we can potentially bring that cost down is turning towards savings and scholarships, work studies, or grants. So obviously savings, we're going to talk about 529s as an option to do that. That should be ideally the base of your pyramid. So you can save that money, pay it right away. Don't have to worry about student loan debt or any borrowing. Scholarships, grants, and work studies are similar. Obviously that's earned, but it's earned money that again isn't adding on to that student loan debt that your student or yourself are experiencing. And then loans are a are a way that people fund school, and there's nothing wrong with loans. We use loans to buy homes, obviously to buy cars and other things out there. But the important part is it has to be done in a responsible way, and the way you minimize your loan exposure and to make sure it's in a responsible way is to have enough savings to even have a down payment on a home or a down payment on a car. That's the way we reduce our loan amount and keep it at a sustainable rate if we have to pay that off in the future. So not demonizing loans, they are necessary, and there's nothing wrong with taking out loans. It's just doing that in a responsible way and hopefully planning so that we can take out as few of those loans as possible when that time comes. So this is just an example of showing you the student loan debt that people are graduating with. It's close to $40,000, actually above $40,000 now. This number was in the 30s a couple of years ago again, but it's one that's rising. And these examples here are just to show you what $42,000 could earn you if you were to use it for other purposes. So obviously a down payment on a home, 10% down payment on a $390,000 home, two Super Bowl tickets. That's the full cost of the $42,000, but two Super Bowl tickets, things like that that you could use these funds for. So just giving you an example of that's a $536 note per month. You can do a lot of different things with that money, or the total amount. Obviously, there's a lot of different options you can do if you just had that money sitting in an account, ready to go. So just a little bit of encouragement to show you, how that can be a pretty big drag on a lot of young adults finances, but also parents' finances, because we see parents taking out parent plus loans. And another quick thing I'll mention is that with some recent legislation that's passed in the past year, if you remember the big beautiful bill last year, there's a lot of caps on parent loans these days. So, if your kid does get into that dream school and it's looking pretty hefty in terms of what you have to pay, unlike the old days where you can kind of take out as much as you want, which was dangerous, but it was possible. There are some caps in certain situations now, so it could be that you would have to tell that child, I know, Stanford's your dream school, but we just can't do it. There's no way we can afford the loans, at least, with federal loans, some of the other loans out there, if you don't want to take private loans. So these are important conversations to have to start to save early or, have that planning in place to make that a possibility. So the bottom line here is college can be expensive, and savings can really make a difference in the school that they attend, in their future, in a lot of different ways. And I often hear in the field that people, say my child is 1 or 2, we have time. That's the actual opposite that I would say. At least that's the exact opposite on philosophy I would have. I would have the philosophy that, wow, they're young now, we can start saving early and have enough money for school or have a good amount of money to pay for school. So starting early is actually the best. And even in my case, I don't have any children yet, but I'm already saving in an MESP account in my own name, which you can do. So starting early is really a benefit because those gains do compound. You get the tax advantages, and we'll get into that here pretty soon. So you'll have an idea of choosing why choosing MESP has been a great program for so many people. So talking about MESP, it's a tax advantage way to save for higher education. So that's what tax code 529 is, which MESP is a 529 program. You may hear about other 529 programs in the state of Michigan being met, which is the Michigan Education Trust. That's a prepaid program. And then there are some advisor paid programs out there, or advisor ran programs out there. They do come with the advisor expertise, but they often have higher fees and commissions. MESP, because it goes directly to you as the client, are able to offer some very, very low fees, which we'll talk about later. So this program is a state of Michigan program. So TIAA is the company I work for, but the state of Michigan has contracted us from the beginning of this program to work on behalf of the state and do the investments and the marketing and all the compliance work that comes with the program. So you get a Fortune 500 company that's been around for over 100 years. Actually, our main business is retirement, and our first client was the University of Michigan. We actually focus on retirement for higher education institutions, and University of Michigan was the first client. So always a cool story to tell. And we have been the program manager for this entire time that MESP has been around, which is going into the 26th year. So MESP is a direct sold program, and you do get tax benefits when we talk about those tax advantage ways. The first is tax deferred growth. So the money that goes in, as Bob mentioned, there's a lot of accounts out there that are taxed as you're earning the money. If you're getting dividend growth, if you're buying and selling investments, there's a tax bill that comes with that. With MESP, no matter if the money's moving around in the account or you're earning some bond income or yield, you're not being taxed on that while it stays in the MESP account. Those account earnings can come out 100% tax free. So all those gains that you experience in your account, so unlike maybe a 401k program where that money goes in pre-tax and you have to pay tax on the way out, this money has already been taxed when you received it, whether from your paycheck or if you're a business, you have to pay those taxes eventually. But once it goes in the MESP, again, it doesn't get taxed when it's growing, and then all those gains you can take out tax free to pay for qualified higher education expenses, which there's a bunch, and we're actually going to get into that in depth a little later in the presentation. The last tax advantage is that Michigan taxpayers can get a tax deduction each year. So it's $5,000 if you're a single filer or $10,000 if you're a joint filer. So that's a total amount per year. But if you were to give that amount, say your family's making, just to make the math easy, $100,000 per year, and you put away $10,000 between your spouse and yourself, that would reduce your Michigan taxable income to $90,000 for that year. So then the state of Michigan says, we're not going to tax you on 100,000, we're going to tax you on 90,000 instead. So that's a special thing that Michigan residents get for investing in MESP. So that's a pretty big benefit, along with the low fees this program has. Makes it a very good program for Michigan residents. It would be very hard to find any other sort of program and be able to manage it in a way to beat it. I can't say it's impossible for compliance reasons, but an investment professional, I wouldn't dare try to invest in another program for higher education savings to try to beat this program. I don't think I would be able to do so.
John,
Um,
actually, to your point about that, I think that's a question that does come up a lot, and you probably hear when you talk to folks out in the state, across the state, of clients thinking, well, wait a minute, it's a Michigan plan. I'm a Michigan resident. Does that mean I can only use a Michigan-sponsored plan? Many states, or across the country, have different 529 plans, and technically, to get the federal tax benefits, you can use any one. But it's kind of nice to know specifically that advantage. Some states, not all states, but like Michigan, will have these state tax advantages, which can be pretty powerful depending on use of it.
Yes, yes. Sorry, I'm flipping around the slides a little bit here. My apologies. But when we go back to what you're talking about, 529 code is a just a tax code. So anybody in any other state, as long as they're a U.S. resident, can use this program. And we actually see people in other states using Michigan's program because it is a low fee program. So think about residents of states that don't have a state tax deduction, or maybe it's a plan that doesn't have low fees. So I've talked to clients in states across the country about MESP because they look at their own state's program and they're saying to themselves, well, my tax deduction isn't great, or I don't have one. The fees are higher for an 18-year period or 15-year period. If I were to map it out, which we do have the resources on our website, it would be cheaper, or at least from a fee standpoint, for me to invest in MESP. So they actually do that. And so when you think about that as a Michigan resident, it's you get the tax deduction and you get the low fee. So that's why I really say I wouldn't hazard, I would bet any amount of money for someone to try to beat it and with another program, just because it would be very, very, very difficult to do. And just with those, combined tax advantages and low fees. So it really makes it an attractive program for Michigan residents, but it's also an attractive program for people in other states who are looking at who have other factors can consider on the tax front and fee front as well. We're going to talk about how to open up an account. It's very easy. So the structure of 529 accounts in general, MESP included, is that there is one account owner and there is one beneficiary. Now, the good news is if you have multiple children, or you're a grandparent with multiple different grandchildren that you're saving for, you only have to have one login. So you don't have to worry about keeping track of 5 different logins for 5 different grandchildren, whatever the case may be. There's one login, but from there you can open up accounts that you'll see all in one place for beneficiaries. And beneficiary just means the student that you're saving for. The successor you can name on each separate account. So, if you have different grandchildren that you're saving for, and obviously there's different parents sometimes in that situation. You have one child that has several of your grandchildren, another one that maybe just has one. You can name separate successors for those accounts, but you're going to open that account. It's only $25 to get started, and some of the information that you need is your name, social security number or tax ID number, permanent U.S. address, an email address, and then a bank account to give the initial $25. And we'll talk a little bit more about those contribution limits, which are a lot higher than that. For the beneficiary, they just need a name, social security number, and a tax ID number, and then their date of birth as well. So don't need much information to get started as long as you have that name, date of birth, and social security number for that beneficiary. Easy to get started. You can open an account online. Usually only takes 25 to 30 minutes if you have all the information, and we'll walk a little bit through what some of your options are there as you're getting started with the account. But to know why you would think about opening up an MESP account, because we get a lot of questions, or at least I get a lot of questions on people thinking about the eligibility rules for these accounts. So the first thing I want to talk about is some misconceptions. So as Bob and I were talking about this call, we get a lot of misconceptions about time limits, which there are no time limits with this account. You can open one up. Whenever, like I said, I open it up for myself, it will be open as long as I'm alive or until I exhaust the funds out of it. There's no time limits there. Who you can open it up for, again, any U.S. citizen that you'd like. They just need to have a tax ID number or social security number. There is no contribution schedule. It's $25 to get started, and that could be the only contribution you make. Now, hopefully that's not the case, but if you wanted to, that could be the $25 to get started, and it can grow from there. And then you can withdraw the funds. The funds do come with a penalty when you do withdraw for a non-qualified purpose. We're going to run through that a little bit later, but I do want to at least upfront say that there is an ability to withdraw, and it's not like you lose all the money that was in that account or the original money that you put in is somehow impacted by that. Now, when we actually talk about using it for a qualified purpose, the good news is that there's a lot of different things you could do. So the money can change between beneficiaries. You can transfer money from there. The student, as long as you don't transfer over ownership of the account, you as the account owner maintain control of this account perpetually. So it's not something that automatically switches over like a UGMA account. You don't have to worry about any time limits there. You can decide who that money transfers to, how it's withdrawn, all those different good things. Schools. So MET is the oldest program in the state. It's made in the 80s, so a lot of the misconceptions come from that program. MET is still around. It is for public schools in the state of Michigan. It basically locks you in a contract that is indexed to state of Michigan credits, so you can go to public schools across the state. But with MESP, it is a different type of program where, again, it's money that's invested, it's growing with the markets, and you have flexibility to use that at more than 5,000 different institutions across the world. Obviously, most of those, about 4,000 plus, are in the United States. We're talking trade schools, vocational schools, universities. I like to joke that any school in the Frozen Four or March Madness or college football playoff, they're all qualified institutions. And then, like I said, trade schools, apprenticeships, and we'll talk a little bit more about that a little bit later in some other slides. But there's a wide range of qualified expenses. So you'll see tuition, books, computers, and fees on this page. There is more to that as well, and we're going to dive a little bit deeper into that. But just to get some initial some misconceptions out the way, this is a program that is very flexible, that is perpetual. It doesn't have a lot of limitations when you really consider saving for higher education. Okay, so when we talk about impact on financial aid, excuse me, my slide's a little bit delayed, so that's why I keep skipping ahead a little bit. But when we talk about impact on financial aid, I think this is another big point when we're talking about saving for higher education. So with people that have a significant amount of wealth, or at least have built up, they're pretty high earners. There's always that conversation of, why apply for aid, or I know my kid's not going to get any aid, and there's kind of that little conversation they have where there's a little bit of I guess pessimism towards what they're going to get when they're talking to the financial aid office, filling out the FAFSA. So I want to shed a little bit of good news that regardless of how much money you make, there is a big benefit to contributing to, MESP if you have money to save. Now, the first one comes if you are a grandparent. So, why is it important sometimes for grandparents to contribute? Well, there is no, it doesn't count towards the financial aid if a grandparent or someone other than the parents are saving in a MESP account. So if you're a grandparent or you're an uncle or an aunt and you're thinking about saving for a grandchild or niece or nephew's education, you can put money away in MESP and it doesn't impact their aid at all. So no matter how much money you have in there, the financial aid office isn't going to consider that as part of their aid. If you're a parent, that's a similar conversation. Again, it's 5.64% this time as a parent if you own the account and you're sending your child off to school. For UGMA accounts and IRAs, that number moves from 20% for UGMA and UTMA, or it's 20% if it's in the child's own 529 account, because it's student owned. That's a bigger dent on a student's financial aid package, and obviously 50% on an IRA is even bigger, right? Because schools are looking at your assets, looking at your home, looking at your retirement, your income, and all these other things, and they are reducing your aid potentially based on how much of that, how much funds and assets those count for, that you have available. But saving in an MESP account or a different 529 account if you're in a different state, that shields a lot of that money. So even $100,000 saved for education, the financial aid office is going to get that FAFSA back. And if it's a parent-owned MESP account, they're going to say, oh, that's only $5,640 saved for college instead of $100,000. So if you do want to shield a lot of that money from being deducted from your aid package. Obviously, even if you're not getting any aid at all, and you're one of those people that's just not going to get any aid, if you have money in an MESP account, that's a lot of money that you can build up, and you can say to them, "Hey, you can't reduce my aid based on that. So this is money I have ready to go deploy for college. I know I have it, and you can only take so much from it." So this conversation, I think, is important for parents to have when they think about how much income they're going to have to report when they fill out the FAFSA or the CSS, depending on what school they go to, where CSS is one of those that a lot of private schools will have to see some of your aid that you can provide as well. But it's important to have for grandparents too, because they're going to pass down money in many of these cases. So if you're a grandparent or you have a parent that has some money, when you're paying for school, that can be some of the most stressful times for parents. That can be a very tight time financially. So it could be worth having a conversation about, giving some money early in MESP. And the tax advantages are huge for grandparents to do so. There's a lot of advantages to doing that. And so when we look at what you can gift for a year to any 529 account, but in this case, we'll talk about MESP. That is $19,000 for an individual, but it's $38,000 for a couple, and that's per beneficiary per year. So you can give $38,000 as a married couple filing jointly each year without any tax implications, and that's a huge amount that you can give each year. If you are a grandparent and maybe you want to do some planning early, dumping some money in, we call it a lump sum or superfunding. That's a process where you can give a 5-year gift up front per beneficiary. So in this case, you could give $190,000 per beneficiary to as many beneficiaries as you want. And again, this is something that doesn't have any tax implications for the giver. So if you're a parent, you can do this. You're a grandparent, you can do this. You're an uncle or aunt, and you just didn't have kids, or whatever the case may be, or you just have some extra money laying around. These are ways to give, amounts that are pretty aggressive that can grow over time and continue to be, and then will be ready for that child to go off to school. So this is just a great way to avoid a lot of taxes on gifting. It's not subject to a kiddie tax. So if you're familiar with UGMA or UTMA, you might hear that, children there has to be some tax payments depending on how much that account will earn over time. But this is something that you don't have to worry about when you're giving to MESP. So it's a great legacy planning tool, and it's a great way to kick off the conversation about passing money down. So as one of my colleagues says, it's one of the only ways you can get money out of your taxable estate when you're paying taxes. So the money does move out of your taxable estate, and then we did talk about there are ways to get it back. But at the most part, if anything, it's a very efficient way to start giving without any worrying about any tax implications of doing so. Now, the last thing I will say on this slide is if you are doing the lump sum contribution, you do want to make sure to talk to a qualified tax preparer or your tax professional just to make sure that you're reporting it right. It's not a difficult thing by any means, but just to make sure that you're walking through that process, letting them know that, hey, we're splitting up this gift over 5 years, but we're giving all the money in 1 year, and we're just taking that tax that gifting limit up to the height of it for the next 5 years. So just a conversation to make sure you're having with that tax person.
And that's a great point, John, with just the idea of the super funding as a strategy for, essentially getting the 19,000, right? It's just excluded from having to take action and utilize form filing. You're essentially using your lifetime exemption of federal, state, and gift tax if you go above the 19. So great way just to simplify and not really have to report it, essentially. That's the idea of the exclusion amount. So this, like other types of family gifting, really can be powerful. I know we have a lot of conversations, certainly with clients, where this makes sense, and when we know education is a priority, as we can see, it's about really more than just the parents and students. It really has become quite a whole family type of planning when it comes to education funding right now, especially with the cost the way they've grown.
Yeah, no, it's a great point. I think these are conversations that you need to have, especially if this is available. And like I said, it's a very difficult time paying for school and can be pretty expensive. Now, ideally, again, it would work out and there's money available. But if you're a grandparent and you're going to have some money to pass down, and you do want to help your child and your grandchild in a very critical point in both of their lives. This is it's a conversation to have now and maybe give some of that money away early as opposed to waiting till later. It can do a big service to family members, both generations that you're gifting to. Okay, so here's an important part. I love having this conversation about qualified education expenses because it really helps shed light on really provides light at the end of the tunnel. I think when people are saving, and early on when I started doing this and giving these presentations, I think people often need to see the finish line to know why they should even start the race in the first place. So here you get to see a lot of the reasons why you're saving and aggressively, hopefully, in these accounts if you're able to, and really the payoff that it could mean, and also the flexibility that's available. So when we think about saving, obviously tuition is going to be the biggest part for most people's school. When you think about going to school without aid, it's going to be tuition. That's the biggest thing, most likely. So tuition is a qualified higher education expense. So remember that basically means that the money that you're putting in and all the investment growth that's experienced over time, that can come out, all of it can come out to pay without any tax implications. It's like, it's skipping a bunch of taxes. And so really what that looks like in practice is, thousands. I've seen easily tens of thousands of dollars saved on taxes for people that fund these, into the tens of thousands of dollars. And the earlier you start, the bigger the growth is. So potentially it's thousands of dollars back in your pocket that you don't have to get to Uncle Sam. So when we look at tuition, that's one of the qualified expenses that you have there, and that's good at public and private universities and colleges. Again, more than 4,000 across the country, and some abroad too. Trade schools, technical schools, and community colleges. So that's a huge amount of different institutions they could go to. If you're worried that your student isn't going to go to college and maybe is more of a trade school person or maybe more of a technical school, or they're a community college student just figuring it out. There's a lot of flexibility there to make sure that you can pay tuition at those institutions. The next biggest cost is going to be housing and food. Now, this is a slide that Bob and I went over a little bit too because we wanted to clear up some misconceptions here. So, housing and food is covered, room and board is covered on campus and off campus. Now, as a primer, make sure that that student is going to school at least half time during that school year, to make sure that they're eligible. But again, this is good for on campus and off campus housing. The rules around off-campus housing is determined by that university. So whatever school they're going to, that school is, or at least university they're going to, that school is going to have a amount that is expected for room and board for that student. That amount is what you cannot exceed as you're paying out of MESP. So as an overview, MESP, there's no limit to how much you could spend out of the account. It's just a limit of how many eligible expenses that you have, to take those tax-free withdrawals. So if that school says it's, let's say around 30,000, I'm just going to give a number here. Let's say $15,000 for them to live there per year, room and board all included. When you're doing your cost counting for your off-campus housing and food and things like that, you need to stay at or below that number for that school year. You cannot exceed it. So make sure, I know it can be hard with young adults, but make sure you're not exceeding that number. And you want to keep track of that information too, to make sure that they're not exceeding that with their expenses. So important thing to note. And again, as I said, make sure they're at least going to school half time. An important rule too, that's very important to note. They cannot be living in your own home or a home owned by you as a parent. So you can't pay yourself. So they have to be living in someone else. They have to be paying someone else's note there, someone else's another landlord that isn't you. So important that they cannot be living in your home or paying you back for those housing and food expenses.
Great. The other thing, John, too, to keep aware of too, just as any expense, whether it's to housing or the food, room and board, is within the semesters and years in which they're paying for the costs, and when they're actually using and using the 529 to either send the payment. In most cases, for off campus, right, they're going to reimburse either themselves or the student to kind of write the check to the off campus apartment or off campus house for the landlord or company, and just keeping track of making sure it's falling into the semesters and the school year that you're actually taking the funds from. So if you're incurring the costs in 2026, fall semester, that's what you want to make sure you're using, for any 529 plan costs, for example, right?
Mhm. Of course, yeah, that's very important. So, and we'll touch on this a little bit later too, but that's a very important point that Bob brings up is that expenses go by calendar year. So when that school sends you that bill or when you experience that rent payment or whatever the case it may be, you want to keep that within the same calendar year. So if you get something in December, some sort of bill in December, you want to pay that before December 31st because it falls into that calendar year. So again, make sure that the year that you incur the expense is the same year that you pay it. When we get to the withdrawal section, we'll talk about this, but make sure that you are somewhere in that calendar year. If you incurred that expense, you're taking that out again within that same calendar year. So very important to note, and of course, like I said earlier, to keep track of that expense. So another thing that was just that's recently been added to qualified expenses is apprenticeship programs. So again, these are things that you can withdraw money for without paying any taxes, both at the federal and state level. So we have some examples here, which is the mechanic apprentice, elevator technician apprentice, plumber apprentice. And you ever have questions on apprenticeship programs, www.apprenticeship.gov is a website that lists those credentials. So other expenses that are obviously come with school are going to be textbooks. That is covered. So again, if they are buying books off of the school website or off of Amazon or whatever booksellers are still out there or digital booksellers are out there, again, make sure to keep those records. But as long as that's for their courses and they need that, on the syllabus, it says they need it. Those are qualified expenses. Computers too. Just make sure that they are computers that are used for class. If your student wants to buy a high-tech gaming computer because they're a gamer, but they're not using that for school or they can't really justify that for school, that would likely not qualify. I wouldn't take that chance. But if it's an Apple computer they're using to do their everyday school or an iPad that they're using to help with their schoolwork, these are qualified computers, and that also includes software too. So I had someone who went to actually CMU where I also went, but she had a daughter that went to CMU and she got tuition free, but she was an architecture student, and architecture students have some pretty pricey software that they need, and she was able to pay a lot of those software costs out of MESP. So again, make sure that they're related to school, but these are qualified expenses that they do need these for their classes, for their education. So this page, we get a little bit more granular. So as a note, the way it's designated is federally tax-free and state tax-free. So these are two, obviously when you're paying taxes, you have to know this too, but these are two levels of taxes. And I do want to preface by saying that if you ever have any questions about taxes, I'm not allowed to give advice on taxes. You do want to talk to a qualified tax preparer, but I will read the rules as they are and then do have that conversation with your tax preparer. So the first being some other usages for these funds. So the first being student loan repayment. This is a lifetime limit of up to $10,000 for student loan repayment. So you might be asking if I'm saving in a MESP account or a 529 account, I would probably exhaust all the money. Why would I be paying back student loans? Well, sometimes there's some extra money left over. Maybe you're a parent and you have some extra money left over, but your niece or nephew has some student loan debt and you want to transfer some money over to them. That is something that can be done, and they can use that for student loan repayment. Now, depending on the state that you're in, you may want to, well, I should say you should want to look at the tax rules for that, because different states do have different state tax rules for student loan repayment. So you just want to check on that. It also could depend on which state you're in, even if you do have MESP. So let's say you move. It can also depend on, and we'll talk about this in the Roth conversation, but it also could depend on where that student lives as well. So that's, or former student lives as well. So that's a conversation to have with the tax preparer. With private K through 12 tuition, this is something that is, again, tax-free at the federal level, but taxable at the state level. So you are allowed to use $20,000 for a variety of different K through 12 expenses. But basically, the state of Michigan decided long ago, based on the way we fund our schools, that K through 12 and higher education are two separate categories. So there is state tax applicable for money that's used for K through 12 private tuition or other expenses out there that have to do with K through 12. So there's a state tax fee there. That's something that Michigan will have for the foreseeable future. There's no plans on getting rid of that really old legislation. So something to be aware of if you do intend on using some of this money for K through 12 tuition. Now, if you are in another state or using another state's 529 program, again, some states do allow you to take private K through 12 tuition, both state and federally tax free. So if you move or you are using a different 529 program, that's again a conversation you want to renew with your tax preparer in that area or whoever you talk to. Now, the post-secondary credentialing expenses, this was added again in the big, beautiful bill. Now, I did talk to Bob about this about a couple weeks ago. I did get an update. Right now, the state of Michigan was declaring that they believed it was going to be federal or state tax free as well as it is federally tax free. They're having a conversation about that between in the government. So with these things, that's kind of the way it goes. Usually, it's the federal government that we have to worry about, not clarifying the rules. But the state of Michigan is working on this right now. So I can't give an answer on this because it may be. It could be changed by the time I give you the answer. It could be changed next week. It could take a year. So with credentialing, I can tell you it is federally tax-free. They can use it for credentials such as Bob's case. You see the CFP behind him. That's one that would count. CPAs, different certifications out there. The Department of Labor should have a list that's updated that you can look at for those. But as you know, there's a lot of certifications out there, credentialing programs out there that will be qualified. So do look those up, and there should be a wide range that are applicable at the federal level. At the state level, I had to give you not right now because again, I don't want to have to give an addendum to this and whenever that changes or potentially doesn't change. So when that time comes, make sure to either reach out to me or talk to someone who's knowledgeable about these matters to just give that a check. So I'll leave that where it is right now because we're still working through that, unfortunately. Another rollover that I'm hoping will get state tax treatment soon, but is not right now, is the Roth IRA withdrawal. The good news about this is that you can use or withdraw unused funds to a Roth IRA for the beneficiary. So that's the student that's saving for. It can go directly to their retirement. There are no income limits on that withdrawal. So your student, doesn't matter if they're hit the lottery and they're super smart and they get a job at Nvidia or Anthropic and they're making, you know, 200, $300,000. Doesn't matter. There's no income limit, so they can withdraw that money to their Roth IRA. As long as that account's been open for 15 years, the money is sat in there for 5 years, and then you would withdraw at whatever those yearly limits are at the time. In our year 2026, that's $7,500. You just have to make sure they haven't already exhausted their Roth IRA contribution for that year, because this will count as their contribution. Now, typically with Roth IRA, remember there is an income limit, but that is waived in the case that it is coming from a 529 program. And again, that does count as their contribution. Just have to make sure that they're making enough money. Hopefully, they're making at least $7,500 that they can count towards this contribution. But again, they have to at least be making enough money to make this contribution. So that's something that you can roll out federally tax free. It is state tax free state taxed at the moment. So it is state taxed. We're hoping that the state again, we'll work this one out where it won't be state tax free, will be state tax free. Getting my words mixed up a little bit, but will be state tax free. But for now, that is something that is taxable at the state level. But again, these numbers are as they are right now. I imagine that $35,000 mark and also that $7,500 withdrawal per year. Those will likely change in the future. So when it's time, especially if you haven't opened up an account yet, I would recheck these rules. 529s are always expanding in the rules, and they haven't restricted anything since they've been around. They've actually only been expanding. So always good to check back and see what are some new rules that are out there. Maybe they're beneficial to you and your situation. But for right now, these are how the rules stand. But again, there's a lot of flexibility is what I'm trying to drive home. And it's also something that, again, has been pretty flexible throughout the decades as they've expanded what you can use these programs for.
And it plays right in, John, to a lot of the conversations you have from a planning perspective of, well, what if I don't? What if I don't? Again, what if plans change? What if we don't? What if students plan to use all that and there's lots of funds left over, and then feeling trapped that, oh, now I have to take things out as a withdrawal, pay a penalty and taxes on the earnings, because again, it's after tax dollars contributed, so anything that would be considered taxable and subject to taxes. It's the earnings growth, right? So, but even so, with lots of earnings growth, these are just additional uses for funds, post college or post secondary school,
Of
career
course.
oriented opportunities to use some of those funds. So again, expansive use is important especially in the last year to 3 years.
Correct. Yes. Yeah. The Roth IRA was added in 2024. Credentialing was added last year. They expanded the K through 12 amount. About 10 years ago, a little bit more, they added the technology part of it. So these are just expanding. I don't want to comment on any bills, but there are some bills working out of committee and Congress that do expand the rules. We'll see if those do pass. But again, it's something that especially when I don't get too many questions on this anymore, but when I was starting, I think people were a little bit worried about, Congress and do they do this, do they do that? This is bipartisan support. 529s are very popular on both sides of the hill. So they're a feel good product and people, and it's something that again I like to. I can't promise you what legislations look like. I can only tell you what has happened in the past, and what is happening right now. But from that standpoint, they do enjoy bipartisan support, and historically they've only expanded in the usages that Congress keeps passing for them to use. So to Bob's point, everything that you contribute is your money. Now again, markets go up and down. Of course, long-term investing, things usually go up and to the right, but all the money that you're investing is your money. It's already been taxed when you earned it, so you don't ever have to give that back. It's only the earnings part of it that are potentially, could not come out tax free, depending on if you took it for a non-qualified purpose or or maybe the state tax rule is different. But the money that you put in from initial, the principal that you put in, that is money that is yours. Nothing's going to change about that money, at least from a tax and penalty standpoint. Here we go. So I want to talk about some things that don't qualify. So we'll talk about housing and food costs in excess of school housing costs. Transportation costs, this is a big one. So if they're taking, a city bus or they're going to a study abroad program and they have to pay for airfare, or they're just flying back and forth, maybe they go to school on one of the coasts or somewhere they need to fly to. These are not covered, and that includes a car too. So these aren't covered. And the student, let's say the study abroad program, the actual instruction, as long as that's with the institution or a qualified institution, all that, the regular room and board, and also the instructional costs, so tuition, things like that, those are qualified, but the actual transportation is not qualified. So keep that in mind. Gaming software is not. So if kids still play Fortnite these days, that's not something that they can buy some of the other things with. Recreational costs are not. So what they have, like let's say a Planet Fitness membership, or in Michigan State, Crunch Fitness is pretty popular. Those do not count. College application fees don't count. Insurance payments don't count. Unfortunately, parking tickets don't count. I know kids do rack those up. And another big one is Greek life does not count. So Greek life doesn't count. An important distinction is between room and board and Greek life dues. Now, that's an important thing to parse out. The best thing I could suggest is always talk to a qualified tax preparer, but one thing you do want to do is see if you can get a division between the dues that are due to the organization or any other costs that come with the activities that come in Greek life. You want to make sure that those are separate from the actual, room and board part of what they're doing. So if you can get those parsed out, that will probably make that an easier conversation to have when you're looking at how to make sure that these are recorded as qualified for your records. An
And what you're
important,
saying, John, is the living in the Greek, fraternity, sorority type house, or place for living, and having meals there, of course, as well.
correct. Yeah, someone that works in East Lansing, right on Hagedorn Road. If you're familiar with Pizza House or in that area, when you go on campus, you see a lot of Greek buildings, Greek houses there. So as Bob was saying, we're talking about the actual house and living there, and the actual living expenses of being in that house. That's what we're talking about, and then keeping that separate from whatever dues or other activities that are going on that they're paying for. So just the living expenses, the cost of living there, is what we're looking at. And as a quick note, I do want to talk about when I say keeping these records, I basically mean keeping a copy of receipts, whether that be digital or physical. No, typically you're not going to get audited. If you're getting audited, you're probably doing a lot of other things wrong. And that's a whole different conversation. But you do want to make sure that whatever the case is, whatever happens, that they're going to look into everything if you're ever audited. And you just want to make sure that these are in order in case that ever happens. Now, like I said, in my time across my team of more than about, I think we have about 12 to 14 members now in my immediate team that do this type of work. I've only heard of one person being audited who, they're looking at their 529 information. But again, um, that's across decades of experience in this. So it's not something that happens often, but just because it's something that can happen, something that you do want to have prepared. And that kind of launches into this conversation about withdrawals. So as we were talking about earlier, those withdrawals have to be in the same calendar year that you're experiencing those expenses. Um, if not, they could be considered non-qualified. And what that means is, again, all your money that you put in, the principal, is protected from any taxes and penalties. But if it's non-qualified, then those earnings, so that money that would have come out tax-free, is the part that is in jeopardy. So what that looks like in practice, if you take a non-qualified withdrawal, what does that be? Because you exceeded cost, or you took it out for something that wasn't qualified. So again, that's anything outside of the conversations we had about Roth withdrawal or qualified expenses or transferring to another person. If they're outside of that realm, they're non-qualified. And in that case, it's a 10% penalty on the earnings. So again, the money that would have come out tax-free. And then those earnings remaining are added on to your state and federal taxes for the year in which you took them out. So again, all the money that you put in is safe from any taxes and penalties. So that's good news. But again, if you do take it out from non-qualified, some of that money that would have come out tax-free is going to be penalized and taxed. So that's important to note. But I do want to say there are some exceptions. So if your student is particularly bright and they do get into a military academy or get a scholarship, you can take out the value of that scholarship or that cost in the year that they receive it. So if you do want to take some money back for yourself, you can take it back. The only thing it is it is a taxable withdrawal. So you do still have to add it on to your state and federal taxes for the year of the earnings amount that was taken out. But you do get to skip the 10% penalty, which is good news. The other thing with those taxable withdrawals is that that money again has to be taken on the year that it's received, and also it can't be put back in. So you take it out, it's back in your pocket. It cannot be you can't just put it back like nothing happened. So important to note there. And then the other cases are death and disability. So these are also taxable withdrawals. So if something happens to that student where they're no longer able to attend school because they have a disability, or God forbid they pass away, these are again taxable withdrawals. You can get that money back in that case. So there is some flexibility to at least avoid that penalty that comes with a non-qualified withdrawal in the form of a taxable withdrawal. So distributions, we're getting towards the end here, but distributions, they can come online. You can make a phone call and do those over the phone. A paper application is also acceptable as well. So most people are going to do either online directly to the school, so you can make an electronic payment directly to the school. Now, the rules for different schools, or there are different rules for different schools about how you make the electronic payment. Sometimes you do need the student to coordinate that. Sometimes you can just have their student ID number and make that payment. So important to know which school they're going to. Unfortunately, Michigan State right now does not offer electronic payments out of MESP, but many of the other institutions in the state do, and many across the country do as well. If you can't do electronic or don't want to, you can withdraw it to a bank account, either yours or the student's, and then they can pay you, or the student can pay out of that bank account as well. And then you can do a check method as well. Basically, it will be distributed directly from MESP to that in the mail to that school as well. There are fees for these withdrawals. Because they are done by a third party. Unfortunately, they do charge for that, or we do have to charge for that because they're done by a third party. But again, make sure that that withdrawal is in the same calendar year that you're receiving it. If you do want to take less withdrawals to kind of avoid some of those fees, you can do that. Some people might put it on, draw it out their own savings, or draw out another thing and reimburse themselves at the end of the year. That is perfectly fine. Again, just make sure that that expense is being withdrawn from your MESP account before December 31st of the year that that expense is incurred. So again, some people take withdrawals throughout the year. Some people just do one big one at the end, or a couple big ones to try to avoid those fees. But I want to be transparent and just tell you that the rules are December 31st. Everything that you spent that year has to be withdrawn from MESP to be a qualified expense. So things to note is that money invested in MESP has to stay in there at least 8 business days before you can withdraw it for any purpose. A 1099-Q is given to you in the year that you make withdrawals. So in the years you're contributing, building up this account, there is no tax document. There is a space on we do give you statements that you can look at, and it's very easy to figure out how much you contributed in a year on our online portal that you can access anytime. But we do give you a 1099-Q when you start withdrawing, and that is a tax document that you would likely want to submit and talk to your tax preparer that you would likely have to submit. And if you are not using your 529s to pay for QHEEs, or sorry, if you are using it, it could disqualify you from some other tax credits out there. These tax credits aren't huge in comparison to typically the cost of a 4-year institution, but again, it could disqualify you from those tax credits, so you want to be aware of that. And again, make sure that you're staying within that. The max tax deduction that you can take is a total amount of $5,000 filing single and $10,000 filed jointly per year. So again, you can continue taking that. If you're not taking withdrawals at all, you don't have to worry about contributions minus withdrawals. But in the years that you do start withdrawing from that account, you do have to do contributions minus withdrawal. So let's say I took out $20,000 from the account and then I put in $10,000, well, you wouldn't have a tax deduction that year because you took out more than you contributed. So once you start taking withdrawals, and in many cases, because higher education is probably going to be a pretty large withdrawal, most people aren't eligible for any tax deductions from their state taxes that year, just because, again, their withdrawals are exceeding their contributions. So important thing to note there. So in summary, consult a tax advisor for any questions you have. Keep good records. Check with the financial aid office. It's always good to have ongoing conversations. I know my parents did when I was in school. Keep those receipts going or in store for at least 7 years. And then please do follow the IRS guidelines on QHEE. This information here is at the top. That's basically the customer service line. That doesn't reach me. It reaches our customer service line. So if you're online and you're looking at your account and have any technical difficulties, contact them. But Jenny and myself are here to answer any questions on the rules, provide you more information from an educational standpoint on how these accounts work. Our website is misaves.com, and you can open an account there and find a whole bunch of resources there. We have a college calculator to help you estimate the cost of college and how much you should save. And then you can schedule an appointment for free with Jenny and I. Most business days, you can find us, at least one of us, but you can schedule an appointment for us, and that's at no cost as well. And then feel free to shoot myself or Jenny an email at any point. Usually can respond to those pretty quickly for some quick questions or any other, more detailed things that you want to set up. And then from my end, I do have to give out this disclosure, but basically it does say that everything I talked about today in this presentation is available in our program document, which is on our misaves.com website, and it runs through everything from how to open an account, the rules, to what happens if you go into bankruptcy, and how these are treated in bankruptcy. So I do want to make sure that you know that those are available for questions there. With that, Bob, hopefully I didn't take up too much time, but I'll pass it back to you.
Well, thanks, John. No, this is great conversation, and as we can see, I mean, there's been so many changes even just in the last couple of years to be aware of, and with more of that flexibility, more options, not only for using the dollars for different kinds of education, but then all the different options for how you can use the dollars after school age or into launching careers or late mid careers as far as using things for credentials and certifications and things of that sort now. So lots of different ways to do that. With that flexibility, though, certainly comes nuance, comes some complexity. Can't be totally afraid of a little bit of complexity with things. But what that means is smart planning and doing good planning and thinking through strategically and being intentional of how you're deciding where to save, not just how much to save, and then using these tools effectively. And again, it's a family, beyond just kind of core family. It could be outside of, parental and student child. It can be grandparents, great grandparents, aunts, uncles, friends that would be involved potentially in ways of helping and saving for family members or friends' education. So lots of planning opportunities there. If you're, certainly a client of the center, I'm sure you're having conversations, continue to have, your conversations, talk with your planner. Certainly, if you have any questions, we'd be happy to answer those. Feel free to contact me with questions after. We will offer, certainly, be happy to do a fee waived complimentary 30 to 60-minute consultation to answer any questions about your college savings strategies, so college savings questions, things that are on your mind, or your overall financial planning and investment goals in general, and how, of course, college savings fits into what we would think about as a good, sound financial plan. You, of course, have ways of connecting with John directly as well. If you have any questions for him about the MESP as well, plus other resources. So our Money Center blog, always having good content. They're education related things, of course, tax planning, investment planning, and other financial planning related topics out there weekly, as well as staying current with content that we have, as well as upcoming events through the rest of the summer and through the rest of this year. Go to a centerfinplan.contact and sign up for our newsletter, blogs, and webinars and events. So a couple great things as follow up. Just let us know if we can be a resource at all. And otherwise, thank you again so much for joining us. Hope this was very helpful and spurred some additional questions. And other than that, have a wonderful rest of your summer.
Thank you, everyone.